Hello and welcome to Money News on Newsmax TV. I'm John Bachman. Joining me right now from London is Dr. Peter Warburton. He's the director of Economic Perspectives, a consulting firm based out of the UK. He's also the author of Debt and Delusion, Central Bank Follies That Threaten Economic Disaster. Dr. Warburton, it's always good to have you with us.
Pleasure.
All right, so looking at the prospects for the rest of 2013 and beyond, there seems to be a little bit more optimism about the European economy than, say, this time last year. And we're not just talking about Germany. Even Spain has raised its expectations a little bit. What's behind the European optimism?
Yeah, so the European economy was in a very dire state last July of last year. And so basically some of the improvement we've seen is just a technical rebound from that. So rebuilding of inventory, having industrial production that was flat is now up in most countries, and we had some decent figures for August out this week. Another thing is that the countries like Spain and Greece have been forced to close their external deficits. Now, in the case of Spain, they've had some improvement in exports, but in other countries, it's just been cutting back on the imports that they bring into the country. And so it's not such an optimistic picture. But I think Europe could push on and have a slightly stronger growth from here, but it rests really on two things. It rests on businesses reviving investment, which is currently in a very weak state. And the other is consumers, particularly German consumers, are still basically staying away from the shops.
So while we look at things as improving, it's really improving from when things were really bad. So relatively compared to a normal economy, whatever that means, things aren't as good as they should be, but still moving in the right direction, right?
Yeah, I mean, I think in the corporate sector has had the means, to do more hiring and to do more fixed investment, but it really there's very little sign of it. And the jobless rate in Europe is 12%, and it's still rising.
Yeah, so there's always a, kind of a rub to any piece of good news. Looking at Spain specifically, kind of a unique situation there. We're just announcing, though, that they're going to continue with some of the austerity measures that have been put in place, even though the economy has started to improve a little bit. Is this a sign of, a telltale sign of a case that that austerity can work when done a certain way?
Yeah, Spain is interesting. I mean, it's not at all clear that Spain is playing with a kind of a straight face here. There are some suggestions that that they are relaxing some of their fiscal discipline, but just kind of doing it in a way that doesn't look so obvious. So that there's certainly opinions that this is not an entirely kind of honest portrayal of Spain following through. I think what's interesting about Spain is that some of the businesses are really gaining strength, and so in Spain you've got some really kind of strong brand. Obviously, you've got a lot of auto production in Spain. There's a lot of industry that actually investment-wise, in terms of equity investors, have really beaten down those stocks, and so the scope for revaluation is still there.
So nowhere to go but up, perhaps, is one way to characterize that. We've also talked about how we're seeing an influx of capital into the European markets faster than we're seeing money invested in the S&P 500 here in the United States. Is this a trend you see continuing over the long term?
I doubt that, because really in the last 3 months, yeah, you're right. We've just seen a huge preference for Europe, which obviously is a reflection of this improved news flow and starting to see a little bit of growth poking through. And obviously, people point to Germany, as being leading the way, and obviously the German economy is easily in the best shape of any of the majors. But I think. We're still waiting for Germany to form its coalition government. We're still not sure how severe the German, kind of the new government will be in terms of its attitudes to Southern Europe. Portugal is very close to needing another bailout, another rescue. Greece needs more money, not a lot of money. 10 billion euros is nothing compared to what they've already had, but it's just, there are some issues bubbling up. And, people are talking about the European Central Bank, having to make another move before the end of the year.
So we talked about optimism, but it's obviously not all roses and sunshine, so to speak. A lot of European investors, of course, are also looking to the government shutdown here in the United States and the federal government's flirtation with default. But we've also had another big announcement over here recently, and that's the appointment of Janet Yellen to replace Fed Chair Ben Bernanke. How was that announcement viewed by European investors?
I would say generally with relief. I think certainly when Larry Summers was in the frame, I think a lot of people were kind of nervous that quantitative easing might be pulled, very kind of quickly and kind of without a lot of ceremony. So Janet Yellen has, been thought of for some time as being the most natural continuation of the policies of Bernanke. And I guess she shares even more strongly with Chairman Bernanke the bias to the labour market, on wanting to see stronger outcomes in the labour market before beginning to withdraw stimulus. I think Europeans probably not that different from investors generally in really being somewhat relieved at having someone who's been in the room, for these last few years.
Yeah, Yellen certainly mentioned that you talked about her appeal towards labor. She mentioned job creation in her address from the White House when the announcement was made. So that's clearly a focus there. And one of the Fed's central roles in all this is ensuring minimum unemployment. So we'll see what happens on that front. The last thing I want to talk about with you quickly, as the pieces are still coming together in Washington, there's been this push by Democrats to restore some of the government funding that was wiped out by the sequester cuts that we saw starting in 2011. But even if that happens, you say recent deficit reductions in the United States have still moved the needle in the right direction. Is that correct?
Yeah, it is. I mean, obviously, America has had a very large fiscal deficit, more than $1 trillion, until very recently per year. But there was a survey recently carried out of Americans, and only 6% of them said correctly that the deficit was coming down. Most people believed the deficit was still going up. And I just really want to reflect that this year, compared to last year, this is the year just completed, the deficit's little more than 4% of national income, down from almost 7%. That's a huge reduction in a single year. And most people, if you told them that at the start of the year, said that America would be in recession, swallowing that kind of reduction. So this is a year when I suppose America was doing some catching up in deficit reduction, and Europe has stalled, basically. There's no improvement this year overall. So even if America was to have to give back, some of that, maybe sort of in the process of reaching a resolution to actually relax some of that and increase the deficit a little, it would still be have made a huge improvement this year.
Yeah, it is a huge amount of money. I mean, it doesn't make a lot of sense to the average American or the average European when they see the difference between the $1 trillion deficit and the $860 or $50 billion deficit, which is currently what we're running right now. But as you mentioned, a step in the right direction. So we'll see what happens in Washington. Dr. Peter Warburton, thanks for being with us. As always, it's a pleasure speaking with you.
Thank you.
And thank you for watching Money News on Newsmax TV.